A lot of entrepreneurs think that as long as sales are coming in, then they are building wealth. But the question is, are you really, or you are just moving money around? Now, in this video, I'm going to help you understand the balance sheet. So what we're going to do is break down exactly what the balance sheet entails and how you can analyze the balance sheet to make sure that you are not just moving money around, but you are purposefully building wealth so that you see the growth pattern of your business from where you are right now to where you want to be. Watch till the end so that you can see exactly how we can help you through a live demonstration right here on this particular video on exactly how to make your own balance sheet and how to understand each and every part or component of that particular balance sheet. And I'm also going to be issuing a free gift that you can use in order for you to understand wealth creation in line with a balance sheet. Hi, I'm Kenneth Phiri from Phiri Consulting, where we help entrepreneurs like you build scalable, profitable, as well as fundable businesses. In this past series, we've been talking mostly about financial tools that are needed for you to start scaling your business. This far, we spoke about the cash flow projections, the income statement, and today to understand exactly where your business is in terms of its financial position, then we're talking about the balance sheet. So, in essence, the balance sheet actually shows you the financial position of the particular business that you'll be talking about. Now, in most cases, it is so difficult for entrepreneurs to know whether they are actually creating wealth or they are actually not. So, the balance sheet then becomes that kind of tool that you will need to see exactly where you are if you consider what is coming in, if you consider what is going out, what you owe, and what you've generated. How much of that belongs to the business? How much belongs maybe to creditors? And how much also belongs to you, to the owner? So, in this, you can tell whether you're growing or you are shrinking. Now, in most cases, the case is that you might see that even if you could be making sales or making profits, you could also be over leveraged, meaning that a lot of money at the end of the day, when everything else has been considered, you end up in the negative or you end up in a very, very small position. So, we want to explain exactly to you through this video how you can find out exactly what your financial position is as far as your business is concerned. I guess the first question that we should be answering first is, why does the balance sheet matter? Okay, now the balance sheet matters because it shows you exactly what the business owns and what you own, right? And it also, there is a clear distinction in terms of what you have built as yours, what you have amassed, which means this is what you own or your portion in the business, and exactly how much you owe, right? If you know how much you owe, then it is easy for you to know exactly what you are left with after making some revenue, income, and so forth. So, to understand the balance sheet clearly, then we always go back to what is known as the accounting equation. In the accounting equation, it states that assets are equals to owner's equity and liabilities at any given time. If this does not balance, then it means that either something was not properly entered or there is a problem basically in the business. Assets is equals to owner's equity plus liabilities, or others would like to say assets is equals to liabilities plus owner's equities. The reason why they put liabilities first is that liabilities must be paid from the assets that you have generated. So, obviously, their liabilities are going to eat up on those particular assets, which means they reduce the valuation of your particular business. So, the greater the assets, then the smaller the owner's equity. Because at the end of the day, for you to get the owner's equity or what is due to the owner, you're going to say owner's equity is equals to assets minus liability. So to see whether the owner is growing in terms of what he has invested in the business. It could be shareholders that you have brought in, or it could be your very own specific amount. How much have you grown since you put in the money? You are going to look at the assets that you have generated, separate the liabilities that you are supposed to pay from those assets, and then what remains, it is what is due to the owner. So we call this owner's equity. On the other hand, if you want, you can say liabilities is equals to assets minus owner's equity. So whichever way, you can always play around with the accounting equation for you to get the right kind of information that you want out of it. Okay, now to understand this much clearer, what we're going to do is we're going to break down an example of a balance sheet for a service business. Okay, now this is merely an example, but the procedure and the processes and the parts of the balance sheet remain standard for most balance sheets. So it is important for you to follow. Please follow through. And if you've got any questions concerning any part of the balance sheet, then please do leave a comment and then we'll attend to those. If you have made it this far, please also consider subscription to the channel. Now, like I said, we're going to look at the balance sheet for a service business. Now, in that particular service business, we're going to break down how everything goes from where we started, where we spoke about assets. So assets are the first thing that you enter there. Now, assets can also be or must also be categorized. There are different categories of assets, and the main distinction first is to categorize whether you've got current or you've got non-current assets. So as you see in our balance sheet here, we are starting with the non-current assets. The non-current assets there are assets that cannot be easily converted to cash. All right. Mostly these are examples such as tangible assets. It could be equipment. It could be buildings. It could be land. These are called non-current assets. As you're going to see there in our example, our non-current assets are 120,000. Okay. Now, if you come down from there, you've got current assets. Now, current assets are all those assets which are either cash or can easily be converted to cash. And then the first one is trade and other receivables. So it means that here, out of that 510,000 rand or dollars or pounds, whichever you're using, 250,000 of that is trade and other receivables. Now, you might be asking yourself, what is trade and other receivables? Then trade and other receivables are just monies that could be coming from your debtors who bought on credit. It could be other payments that are coming by way of you trading a particular product or service. And then cash and other equivalents amounting to another 260,000 there. This could be all the other cash that you have. It could be cash in the bank, petty cash, and anything else that is easily cash there. All right. And then this will give you the total assets. So the total assets are made up of non-current assets plus current assets. Now, in our example, this goes to an amount of 630,000. Okay. Now, once you've got the current assets or the total assets, remember now you've already determined the first part of your accounting equation, which is the assets. So we remember what we said. We say that assets are equals to owner's equity plus liabilities. So which means you go to the right side of your equal sign where you find equities and liabilities. Now, under equities and liabilities, the first thing that you're going to find there is the shareholders' equity. All right. Now, the shareholders' equity, shareholders are those that own a part of the business, which means they have invested in the business. In our case, the shareholders' equity is divided into two types of entries there. The first one is the ordinary share capital, which amounts to 300,000, and then the retained income, which is 90,000. All of that makes 390, which is your shareholders' equity. All right. Now, which means this is money that goes to, or that is accounted for, the people that have invested in the business. All right. And then next one is going to be your non-current assets. I mean, non-current liabilities. Remember, we also have got two types of liabilities, either current or non-current liabilities. Now, non-current liabilities are all those liabilities that cannot be paid up within a single year. Usually, these form long-term liabilities such as mortgage loans and stuff like that. So, which means you've got a longer time span in which to pay that particular liability. So, in our case, we've got there a long-term loan. It could be 5, it could be 10, it could be 20, 25 years, like some mortgage loans. So, and that comes to an amount of 100,000 for that long-term loan. Okay. And then the second part of your liabilities is made up of current liabilities. Just like current assets, current liabilities are all those liabilities in this case that are payable within one calendar year period. So, which means we are looking at short term responsibilities that you need to take care of or you need to pay as a business. Okay. Now, the first one is trade and other payables. For instance, you're paying for inventory and stuff like that, or monies that is owned to certain creditors and so, but that you must pay within 1 year, and then this is accounted there. The next one is your short-term portion of loan. Now, your short-term portion of loan is the loan that you must pay within a year. Sometimes you find that you've got a long-term loan and is broken down into smaller parts. Okay. Now, this is the portion that you're paying in the short term, which is in the year or in 1 year. So you need to put that down. And then also other payables include a income tax, which is paramount for all entrepreneurs to make sure that you pay your income tax. Now, in South Africa, you pay that to SARS. Make sure that all your tax is paid up and full. If you've got questions concerning tax, please do leave a comment and we'll find a way to help you. That will take us then to total equity and liabilities. A total equity and liabilities is the combination of the owner's equity plus both long-term and short-term liabilities. It gives you that. Now, what you need to find out then is, does this balance? Okay? What I mean by that is that when you take the total value of the assets and then subtract the owner's equity and the liabilities, does it give you, it must give you a zero there. As you will see in our example here, the total assets amounted to 630,000. And then the total equity plus liabilities also gave us a total amount of 630,000. What it basically means is that this has been done properly, because at the end of the day, as long as there's that equal sign, what is on the left side, which is assets, must always be equal to what is on the right side, which is the owner's equity and the liabilities. So at all times, always make sure that this balance. All right, and then the question then will be, how do you use this information? Now, the information in the balance sheet actually tells investors or even banks exactly how secure your business is. That is the most important thing. Is the financial position of your business healthy? Is your business secure? Is it a business that they can invest in? Or is it a business that they should be running away from? The second thing that makes your balance sheet useful is it shows exactly whether you're growing your business from profits or you are just staking up debt. Now, if you're staking up debt, it means therefore that your liabilities are going to uh, grow at a rate that is faster than your assets. So that basically shows that you are in the red because what you have done is you have or you are financing most of your growth, or your business operations are being run primarily on debt. Then that is always a cause for concern. Now, what you can then look at from this point moving forward is to look at trends. What are the trends in your particular balance sheet? Now, remember, you can create a balance sheet on a month-to-month basis, quarterly, annually, and so forth. Now, in there, trends will emerge. Now, the emergence of those trends tell us exactly how fast your assets are growing as compared to how fast your debt is growing or is shrinking. So you can actually try and find trends within. If you compare a balance sheet from one calendar period to another, either on a month-to-month basis, on an annual basis, and whatever the case might be for a time period that you have chosen, you can actually track and find out the trend of your assets. Are they growing or shrinking? If they are growing, at what pace are they growing? What about your liabilities? Are you reducing your liabilities? Do you have a healthy payment plans for your long term and for your short term debts? This can be easily seen in your balance sheet, and it proves exactly one, how secure your business is and how healthy the financial position of your business is. To help you, this is what I've done. I have created a free and easy to use balance sheet template which you can get today for free. Is going to follow precisely the same steps that we followed in our particular example. You must be able to fill this. If you've got challenges filling it, you can leave a comment and then we can find a way to assist you. Otherwise, this will give you clarity as to whether you are creating wealth or you are just amassing some debt, or you're just moving money around. Either you're moving money from your assets to your owner's equity and it comes to liabilities and there is no growth. You find that the same amount or the value of your business remains the same. So feel free to reach out, comment, and also like, share the video so that we can be able to help you. Be always on the lookout for fresh and exciting content that we're bringing you concerning these financial tools. Next, we're going to be talking about financial ratios to measure exactly the performance of your business using specific key performance indicators that are financially based. So please make sure that you hit the notification button and subscribe so that you don't miss out from the quality stuff that we're going to be bringing you. Always remember also that early preparation equals excellent results. Let's prepare now to avoid heartaches and problems in the future concerning your finances. Please subscribe. This is Phiri Consulting. Thank you for watching. We'll see you in the next video. Bye.